Hi, in this video I'm going to talk about the cash flow statement and the relationship of all the three financial statements. So make sure to stick around as we're starting right now. The cash flow statement provides supplemental information that was missing from the income statement. The income statement gives the net income, but net income is not always cash. The income statement does not talk about the cash the company has at a point in time. A typical example for this would be a payment made in the form of a post-dated check. As far as the income statement is concerned, a post-dated check is income and is called out in the income statement. This increases the net income and inflates the revenue, but the company will not have the cash until the future date. It is this nature of income statement that makes it deceiving. The cash flow statement will tell why cash increased or decreased from the balance sheet. The income statement and the balance sheet feeds information into the cash flow statement. The cash flow statement is divided into three sections. Firstly, cash flow from operations. This is nothing but the cash generated from the business for less than a year. Next, we have cash flow from investing. This is cash invested in long-term assets like land and machinery. Finally, we have cash flow from financing. This section shows the flow of cash that is used to fund the company. Companies may raise funds by taking on debt or pay off debt, and this kind of financing activities fill up this section. That being said, let's discuss a sample cash flow statement with the help of a sample income statement and balance sheet. Cash flow from operations is calculated from the income statement and the balance sheet and is done in three steps. First step is to add the net income, which is derived from the income statement. Then we add non-cash items from the income statement. Depreciation and amortization is a non-cash item we are looking for. Next, we add non-cash items from the balance sheet, which includes inventory, accounts receivable, and accounts payable. Summing up all these values gives the cash flow from operations, which is $310,750. Next, we have the cash flow from investing. For this, we use the balance sheet. The amount spent on long-term assets is extracted from the balance sheet to derive the cash flow from investing. In our example, by looking at the balance sheet, it is clear that the company had spent an additional $10,000 on land and $50,000 on machinery. This is considered money out of pocket, and hence we need to subtract it from our cash reserves. So the total cash flow from investing is a negative $60,000. Finally, we have cash flow from financing. For this, we use the liabilities and equities section in the balance sheet. Liabilities include short-term and long-term debt. Paying off debt means we lose cash to get rid of debt, and a positive equity means we generate cash by issuing shares. So we subtract debt and add equity to get the cash flow from financing. From the balance sheet, short-term debt decreased from $100,000 to $89,250, which means the company paid off $10,750. Similarly, long-term debt reduced by $100,000. Hence, both short-term debt and long-term debt are subtracted. The company during the same period generated an extra $60,000 by selling more shares. Hence, equity of $60,000 is added. Summing up, we have cash flow from financing, which is a negative $50,750. Adding up cash flow from operations, investing, and financing gives the net change in cash, which is $200,000. This explains why the balance sheet showed a change in cash of $200,000 while income statement showed a net income of $375,750. As I said in the beginning, net income is not always cash, and cash flow statement helps to connect the dots between the income statement and the balance sheet. Understanding these statements aids investors in forecasting revenues and future cash flows and helps them arrive at target prices for the companies they are interested in. In my next video, I will be talking about the valuation models that I use to identify target prices. So stay tuned and consider subscribing. Until we see next time, thanks for watching. Bye.